You know, it feels like everybody out there is just chasing the loud hype, right? The trending tickers, the overnight viral sensations. We are constantly bombarded by this noise telling us what we absolutely must buy right this very second. But what if the ultimate wealth builders are actually the ones nobody is talking about? Welcome to The Explainer. Today we're diving into an analysis of 18 quiet, low-profile dividend ETFs. We're going to separate the noise from the truth and find the absolute best assets for your long-term portfolio.
Okay, let's dive into this. Here is our roadmap for today. 1. The problem with hype. 2. The 3 strict rules to filter the noise. 3. Revealing the 6 elite survivors. 4. Hidden truths of investing. And 5. The ultimate wealth strategy.
Section 1. The problem with hype. Loud versus quiet ETFs.
To really get why we're doing this, we have to contrast the exhausting noise of the market with the quiet corner of dividend ETFs. On the one hand, and I'm sure you see this every single day, you've got loud stocks. It's viral influencer hype, promises of overnight riches, literally everyone screaming about whatever happens to be trending right now. And honestly, it's incredibly exhausting. But on the other hand, we have quiet ETFs. There is no viral hype here, no screaming, just steady, long-term compounding and, crucially, significantly lower emotional mistakes. This is really the sleep well at night side of the market.
And quiet is actually incredibly powerful. These quote-unquote boring funds focus on dividend growth consistency. They target strong cash flow companies. When you prioritize long-term compounding and just strip out that daily hype, you inherently make fewer emotional investing mistakes. You stop panic selling. You stop revenge trading. And honestly, that is exactly why these low-profile, boring funds so often just completely outperform those attention-grabbing volatile ones over a longer timeline.
Section 2. The 3 strict rules for filtering the noise. To find the absolute best of these quiet funds, the source subjected a broad list of ETFs to a remarkably strict elimination process. It's kind of like a giant funnel. Step 1. A 10-year total return that is close to or better than the S&P 500 benchmark. Basically, if a fund is chronically lagging the broader market, it gets cut. Step 2. An expense ratio under roughly 0.40%. Why? Because over decades, keeping your costs low absolutely matters. It eats into your profits. And step 3, at least $200 million in assets under management. This is a crucial survival and liquidity check. Anything failing these 3 strict hurdles was ruthlessly filtered out.
Now, the starting point for this gauntlet was 18. 18 low-profile ETFs were put to the test. And guess what? The vast majority of them completely failed. They didn't make the cut. They were either mathematically average, quietly overhyped, or masking some hidden risks. This massive failure rate really just proves how incredibly strict this filter was.
Section 3. The 6 elite survivors. The best dividend ETFs.
All right, it's time for the big reveal. Here are the elite funds that legitimately deserve a spot in a serious long-term portfolio. We can group the first 4 winners into 2 main categories. First up are dividend growth core leaders, DGRO and DGRW. These funds focus purely on companies with strong earnings, healthy payout growth, and the ability to compound over the long run, not just high initial yields. Because of these stronger quality filters, they've historically beaten a lot of popular dividend ETFs over a 10-year stretch. Second, we've got our high-quality yield funds, VYM and HDV. Now, these prioritize stable, large-cap companies. They might not be flashy, but they behave like absolute sleep-well-at-night holdings when market turbulence hits. They are your anchors.
Next up is our 5th survivor, VYMI, the Vanguard International High Dividend ETF. You know, it's so incredibly easy to get total tunnel vision on just the US market, but VYMI offers this crucial, often overlooked diversification beyond the United States. And historically speaking, having this international exposure is incredibly strong during certain global market cycles when our domestic stocks might be cooling off a bit. And then we get to this massive number, 25 plus. This is the baseline requirement for our final survivor, NOBL, spelled NOBL. It's the S&P 500 Dividend Aristocrats ETF, also known as the Stability King. To even be included in this fund, a company must have raised its dividends for a minimum of 25 consecutive years. Think about that.
Now, what's really interesting about this is what that 25-year streak actually means in the real world.
To be inside NOBL, a company had to keep raising its dividend straight through the catastrophic 2008 financial crisis. They had to keep raising it straight through the 2020 pandemic crash. They've had to survive multiple brutal recession cycles right up to today. This ETF represents pure survival-based investing discipline across major historic crashes. It's truly remarkable stuff.
Section 4. Hidden Truths of Investing. Insights from 18 ETFs.
With our 6 survivors identified, what can we actually learn from them? Well, the source material uncovered a few fascinating hidden truths. But before I tell you the first one, let me ask you a question to challenge a very common beginner assumption. Does a higher yield actually mean better returns? Think about it. If a fund is paying out an 8% dividend instead of a 3% dividend, you're obviously taking home more cash and getting better returns, right?
Actually, scratch that. No. Here is the first hidden truth. High yield does not equal better returns. Often, those highly attractive, massive yields actually lag in total return over a long period. Sure, you might get a bigger cash payout today, but the underlying stock value of the fund is stagnating or sometimes even shrinking. You absolutely have to look at the total return, not just fall into the yield trap.
Here are the remaining 2 hidden truths, and honestly, they completely reframe how we should approach building wealth. First, quality beats complexity, every time. Simple, high-quality dividend growth strategies consistently outperform complicated, actively managed ETF structures. Second, discipline beats prediction. The best ETFs out there, they don't rely on some genius manager perfectly timing the market. They are built to simply survive every single cycle. Discipline and simplicity will always beat complexity and prediction for sure.
Section 5. The Ultimate Wealth Strategy. Building a Portfolio.
So what does this all mean? How do we put all of this powerful information to work? Let's combine these elite survivors into one simplified, masterful long-term compounding approach. So the crucial point is how these specific tickers fit together perfectly to create a balanced strategy. It's like a giant puzzle. You use DGRW or DGRO as your portfolio's growth engine. Then you use NOBL as your absolute stability foundation. VYM or HDV serves as your steady income backbone. And finally, VYMI comes in to provide your global diversification. Together, the whole shebang creates a comprehensive, low-hype wealth machine. Now here's a highly practical next step, highlighted in our source material. If you're wondering how to actually execute this easily, especially if you're a beginner, it's more accessible than ever. You can invest in major US companies, like Apple, Nvidia, Tesla, starting from literally just $1 single dollar. You can build this exact global ETF portfolio in under 10 minutes. All of this is available right now on the GoTrade platform, which really just strips away those high barrier entry costs and makes this elite strategy accessible to anyone, anywhere. I'm going to leave you with this provocative mic drop quote from the analysis. Dividend investing isn't about chasing the highest yield, it's about staying invested long enough for compounding to do its job. And sometimes, boring is exactly what makes you money. So, my question to you is, are you ready to tune out the loud hype and finally embrace the quiet, boring path to real wealth? Thanks for joining me for this explainer. Keep learning, keep compounding, and I'll see you next time.